Building a 10-mile private toll road costs $200 million. That equals $20 million for every single mile of concrete. Most people assume the private owners get rich by collecting $3 tolls from passing commuter cars. In reality, a private toll highway is not a transportation business at all. It is a massive debt structure disguised as a strip of high-speed asphalt. By the end of this breakdown, you will see how dynamic congestion pricing produces $430,000 in monthly net profit. You will also discover the hidden contract clauses that force taxpayers to bail out empty private highways when drivers refuse to pay. And you will see the exact financial trap that sends billion-dollar infrastructure funds into bankruptcy court. To understand the economics, you have to break down where that initial $200 million actually goes. Road construction takes the biggest bite. Physical construction claims 55% of the total capital expenditure, or $110 million. That covers heavy earth grading, multi-lane concrete flyover bridges, complex storm runoff retention basins, and thick structural asphalt layers. Acquiring the land takes 20% of the budget, totaling $40 million. Securing a contiguous corridor across hundreds of private parcels requires years of eminent domain negotiations and property condemnation fees. Electronic tolling systems consume 15% of the initial capital, adding $30 million. That pays for overhead steel gantries, high-speed optical license plate cameras, RFID transponder arrays, and vehicle classification laser sensors. Dedicated roadside fiber optic networks connect every sensor to the central data center. Engineering designs, environmental impact statements, wetland mitigation, and utility relocations eat the final 10%, or $20 million. The total entry cost reaches $200 million before a single vehicle drives through. Private consortia rarely fund this with cash from their own balance sheets. They finance up to 90% of the project by issuing municipal bonds. That massive debt creates an unforgiving financial clock. The second the road opens, the debt clock starts running. Bondholders and commercial banks demand a monthly debt service payment of $850,000. That means the road must generate roughly $28,000 every calendar day just to cover interest and principal. Debt service is a fixed obligation. The lenders expect their check whether 500 cars drive by or 50,000. Operating overhead piles directly on top of that debt burden. Road surfaces degrade under tire friction from the very first morning of operation. Bond covenants legally require the operating company to place $120,000 each month into a maintenance reserve escrow. That dedicated cash reserve guarantees the company can fund future structural resurfacing without defaulting on its primary bonds. Electronic toll system upkeep costs $40,000 per month. Optical camera lenses require continuous cleaning, laser profile sensors need regular alignment, and cloud software billing systems charge ongoing hosting fees. Routine roadway operations and incident management add $60,000 per month in direct payroll. That payroll covers emergency patrol trucks, safety sweepers, dispatchers, and customer support staff. Liability insurance, stormwater pond maintenance, and highway lighting electricity add another $30,000 per month. Adding those mandatory line items together reveals the operational baseline. The total monthly burn rate reaches $1,070,000. The operator must clear $35,600 every single day just to keep the lights on and the gantries scanning. Meeting that daily nut is difficult because real-world operations carry unexpected cash leaks. The largest revenue leak is toll evasion and uncollectible billing. Between 8 and 15% of all drivers passing under electronic gantries never end up paying. Some drivers use tinted license plate covers, others drive with stolen paper dealer tags, and out-of-state vehicles frequently ignore mailed invoices. Hiring third-party collections agencies eats 20 to 30% of any past due revenue they manage to recover. Credit card merchant fees take another 3% off the top of every settled toll transaction. When a driver pays a $3 toll, credit card processors take 9 cents before the money hits the company account. Physical road fatigue creates an even bigger financial risk. Highway engineers measure pavement wear using the fourth power law of axle weight. A single 80,000-pound commercial freight truck causes the structural pavement damage of nearly 10,000 passenger sedans. Commercial trucks pay higher tolls, but they destroy the top layers of asphalt at an accelerated pace. Every 10 to 12 years, the operator faces a massive resurfacing project, grinding off the damaged asphalt and laying new structural binder costs between $35 and $40 million. If the company raided its monthly escrow reserves to cover short-term operating shortfalls, that repaving bill causes an immediate cash crisis. Weather creates violent swings in quarterly operating expenses. A single severe winter storm can burn $40,000 in salt, chemical brine, and snowplow subcontractors in 48 hours. Extreme summer heat creates pavement slab blow-ups that force emergency lane closures during profitable commuting windows. The physical asset is constantly deteriorating under weather and traffic. To survive that relentless monthly burn, the operator relies on a carefully designed pricing structure. It begins with the standard baseline toll, During off-peak midday hours, passenger sedans pay a flat baseline rate of $2.50. That baseline applies to casual midday drivers, late-night travelers, and weekend family traffic. Standard baseline traffic provides a steady flow of cars, but off-peak volume barely covers daily operating costs. The real profit engine of a modern toll road is dynamic congestion pricing. Automated gantry sensors monitor lane speeds and vehicle density every 30 seconds. When traffic volume surges and speeds begin to drop, computer algorithms automatically increase the toll rate. During the morning commute between 7 and 9, the toll climbs from $2.50 to $12 per trip. The evening rush hour between 5 and 7 repeats the exact same pricing surge. Commuters willingly pay $12 to bypass 40 minutes of gridlock on the parallel free interstate. Those 4 peak commuting hours generate more than 70% of the road's total daily toll profit. Commercial freight trucking provides a second highly profitable revenue stream. Heavy freight haulers pay between $18 and $25 per trip to guarantee on-time warehouse deliveries. Beyond the toll gantries, the operating company extracts substantial ancillary income from roadside service plazas. The company leases travel center real estate to national gas station chains, fast food restaurants, and electric vehicle charging hubs. Those commercial tenants pay $20,000 per month in base rent plus a 4% royalty on all retail sales. That leasing generates $60,000 of high-margin income every single month. With baseline traffic of 20,000 vehicles per day, total gross revenue reaches $1,500,000 per month. When actual traffic matches engineering projections, the business generates exceptional cash flow. $1,500,000 in monthly gross revenue minus $1,070,000 in total burn leaves $430,000. That leaves the operator with a clean net operating profit margin of 29%. On an annual basis, the asset produces $5,160,000 in cash for equity investors. That consistent cash generation makes toll road concessions a favorite target for sovereign wealth funds and institutional pension managers. But that 29% profit margin is deceptively fragile. The $850,000 monthly debt service is completely rigid. Lenders do not lower interest payments when economic downturns reduce commuting trips or when gas prices keep drivers at home. If daily traffic drops by 30%, the entire economic model enters the fatal danger zone. At 70% of projected traffic, gross monthly revenue falls to $1,050,000. That leaves the company $20,000 short of its mandatory debt and operational obligations each month. The 29% profit margin disappears completely. The company must drain its emergency liquidity reserves just to prevent lenders from foreclosing on the asset. This exact mathematical trap has destroyed massive private toll road projects across the country. Look at the southern section of Texas State Highway 130. Private investors poured $1,300,000,000 into building a high-speed toll bypass around Austin. Engineering forecasts projected thousands of long-haul freight trucks would pay high tolls to escape the gridlock of Interstate 35. The state even approved an 85-mile-per-hour speed limit to draw drivers to the toll lanes. Freight trucking companies refused to pay. They stayed on the free public highway rather than spending $40 per round trip. Actual traffic volume came in at less than half of original projection. In 2016, after exhausting all debt service reserves, the operating consortium filed for Chapter 11 bankruptcy. The Indiana Toll Road suffered an identical collapse after a private group paid $3,800,000,000 for a long-term concession. When the 2008 recession reduced freight traffic by 42%, the company could no longer pay its debt service. The private equity investors lost their entire investment while the road remained open to drivers. Those high-profile bankruptcies transformed how private infrastructure deals are negotiated. Modern infrastructure investment funds refuse to take on unhedged traffic demand risk. They demand powerful legal protections written directly into state concession contracts before spending any private capital. The most common structure today is the availability payment model. Under an availability contract, the state government pays the private operator a fixed annual fee for maintaining the highway and keeping lanes open. The state collects the actual toll revenue and assumes all the financial risk if traffic volume falls short. When private operators do take on toll revenue risk, they insist on minimum revenue guarantees. If toll revenue falls below a contractually defined floor, state taxpayers must cut a check to cover the debt shortfall. Operators also insist on strict non-compete clauses. These non-compete clauses legally ban state transportation agencies from widening nearby free highways or expanding competing passenger rail lines. If the state builds a free road that pulls traffic away from the toll corridor, the state must pay millions in contractual penalties. These aggressive legal clauses explain why global infrastructure funds continue pouring billions into multi-decade toll road concessions. A private toll road is not an operational bet on pouring concrete or clearing snow. It is a legally protected monopoly on human movement through an overcrowded urban corridor. For well-funded investment firms with ironclad state revenue guarantees, a toll road is an inflation hedge cash machine. For operators who sign pure demand risk contracts based on aggressive traffic projections, it is a fast track to financial ruin. Does leasing public highways to private Wall Street funds solve transportation funding shortages, or does it leave commuters trapped paying artificial congestion tolls for 50 years?